Welcome back to Charged Alpha. I'm Hudson Thomas, joined as always by my co-host Lana Chen. In this segment, we're zooming out from the quarterly noise for a full company chapter.
That's right, Hudson. Before we dig into the latest earnings, let's make sure we actually understand this business. What it does, how it makes money, and what makes it competitively distinct.
Kimberly-Clark was founded in 1872 in Neenah, Wisconsin as a paper mill. A century and a half later, it has become one of the most recognizable consumer staples companies on Earth.
The portfolio includes Kleenex tissues, Huggies diapers, Cottonelle bath tissue, Scott paper towels, and Kotex feminine care. These brands command shelf space in virtually every major retail channel globally.
Personal care is the largest segment at roughly 56% of revenue. Huggies and Pull-Ups are number 1 or number 2 in the diaper market across 80 countries, a genuinely global franchise.
Consumer tissue accounts for 35% of revenue. Kleenex and Cottonelle are category leaders in many markets, though private label competition in tissue is more intense than in diapers.
CEO Mike Hsu has led Kimberly-Clark since 2019, having spent his career at the company in North American roles. His focus has been margin recovery, portfolio simplification, and emerging markets growth.
Emerging markets represent approximately 40% of total revenue, and that proportion has been rising. Diaper penetration in developing countries is still well below developed market levels, providing structural growth.
The professional segment serves businesses and healthcare facilities with tissue and wiping products. It is a smaller contributor but carries stable margins because B2B contracts reduce promotional pricing pressure.
Gross margins sit around 35% and operating margins around 18%. Those levels reflect significant commodity input costs, pulp, fluff, and superabsorbents that create exposure to raw material cycles.
The dividend aristocrat status is among the most important facts about Kimberly-Clark. 52 consecutive years of dividend increases places it in a very small group of elite long-term dividend growers globally.
Private label is the structural risk. Retailers like Walmart and Costco have improved their own brand tissue and diaper quality, putting pressure on Kimberly-Clark in price-sensitive retail channels.
Competitively, Procter & Gamble is the primary rival in both diapers and tissue. P&G commands a higher multiple for its broader brand portfolio, but KMB competes effectively in its specific categories.
Private label is the structural risk. Retailers like Walmart and Costco have steadily improved their own brand tissue and diaper quality, putting pressure on Kimberly-Clark's volume in price-sensitive channels.
For income investors, Kimberly-Clark is a foundational holding. Brand moat, global distribution, and dividend aristocrat status provide a durability profile that is rare in consumer staples.
The combination of brand power, emerging markets exposure, and a 52-year dividend streak makes Kimberly-Clark one of the most consistent capital compounders in the consumer staples universe.
For income investors, Kimberly-Clark is a foundational holding. The brand moat, global distribution, and dividend aristocrat status provide a durability profile that is exceptionally rare in the consumer sector.
The combination of brand power, emerging markets exposure, and a 52-year dividend streak makes Kimberly-Clark one of the most consistent capital allocation stories in the entire consumer staples universe.
That's the company chapter for Kimberly-Clark. Now that we've got the full picture, let's get into the earnings.
Time to dig into the numbers. Let's go.
There is a good chance you used a Kimberly-Clark product before you left the house this morning. Whether that was a Huggies diaper for your kid, a Kleenex tissue, or a roll of Cottonelle, this company is woven into the fabric of daily life in a way that very few consumer businesses can claim. And yet, for all that brand ubiquity, Kimberly-Clark trades at a price that has barely moved in years. Today, we are cracking open the Q1 2026 earnings for ticker KMB. The question on every investor's mind: can the Power & Care restructuring plan finally unlock the shareholder value that has been hiding inside this dividend king? Lana, set the stage for us.
Happy to. Hudson. Kimberly-Clark is a Dallas-based consumer staples giant with a market cap of roughly $32.4 billion. The company operates across personal care, including Huggies, Pull-Ups, Depend and Poise, and consumer tissue, covering Kleenex, Scott, Cottonelle, and Viva. they completed the spin-off of their professional segments business, Halex, which sharpened the focus squarely on consumer brands. The stock currently trades around $135 per share. Consensus is a hold, with analyst price targets clustering near $145. KMB has a 51-year streak of consecutive dividend increases, putting it firmly in dividend king territory, and the current yield sits around 3.6%. That income profile is a core part of the investment thesis, even before you get to any growth story.
So let us talk Q1 2026. Kimberly-Clark posted earnings per share of $1.97 against a consensus estimate of $1.93. That is a beat of about 2.1%, which is solid but not spectacular for a company of this size and maturity. Revenue came in at $4.85 billion for the quarter. Organic revenue was down roughly 3%, and that number carries some nuance we need to unpack. The decline reflects a deliberate volume versus price trade-off the company has been navigating. They raised prices aggressively in 2022 and 2023 to protect margins through the inflation cycle. Now, as pricing normalizes, volume is the pressure point. The headline organic decline looks concerning on the surface, but management is framing it as a managed transition.
On the income statement, the earnings beat was driven in part by the Powering Care restructuring program. Kimberly-Clark targets $3 billion or more in gross savings through 2030, and cost discipline was visible in Q1. Gross margins held up better than feared, given the volume softness, and the company continues to reinvest savings into brand support and innovation. Operating income held relatively steady. Below the line, interest expense and foreign exchange both created headwinds, which is a recurring theme for a company that generates a meaningful portion of its revenue outside the United States. The 2.1% EPS beat suggests that even with FX pressure and restructuring costs running through the P&L, Kimberly-Clark management is finding ways to protect the bottom line.
The moat here is real, but it is not impenetrable. Kimberly-Clark's competitive advantage comes from brand loyalty in categories where consumers are creatures of habit. Parents trust Huggies with their newborns. Older adults rely on Depend for dignity. Those are emotionally sticky categories, and the switching cost, while not financial, is psychological. The distribution moat is also significant. Kimberly-Clark products sit on shelves in virtually every major retailer globally. Getting that kind of shelf presence is decades of relationship building. The global supply chain, particularly in emerging markets like Brazil and China, gives them scale advantages that smaller competitors simply cannot replicate. The Danaher business system equivalent here is lean manufacturing and continuous improvement embedded in the Powering Care framework.
Cash flow is the engine that makes Kimberly-Clark relevant to income investors. The company consistently generates strong free cash flow relative to net income, and that cash gets returned to shareholders in two primary ways: the dividend and share buybacks. The 51-year streak of dividend growth is not an accident. It requires disciplined capital allocation and a business model resilient enough to sustain payouts through economic cycles. In Q1, free cash flow generation was supported by working capital management and the structural cost savings from Powering Care. Restructuring charges do weigh on reported earnings, but underlying cash conversion remains healthy. Capital expenditures are relatively modest for a consumer staples company, which keeps free cash flow yield attractive for long-term holders.
On capital returns, the 3.6% dividend yield is the headline, but the full picture includes buybacks. Management has been repurchasing shares opportunistically, and with the stock trading near multi-year lows on a relative basis, buybacks at current prices are accretive to long-term per-share value. The Halex spin-off completed cleanly, which simplifies the capital allocation story. Going forward, Kimberly-Clark can concentrate firepower on consumer brands rather than spreading investment across a professional segment's business with different margin dynamics and growth trajectories. The combination of an improving cost structure, a narrowed business focus, and disciplined shareholder returns creates a cleaner capital returns narrative than the company has had in several years.
3 catalysts that could move this stock higher. First, market share recovery in emerging markets, particularly Brazil and China. Kimberly-Clark ceded some ground in diapers during the pricing cycle, and winning those consumers back drives volume without sacrificing price. Second, the adult incontinence category. Demographics are working in Kimberly-Clark's favor here. The global population is aging, and Depend and Poise sit at the intersection of necessity and brand trust. This segment has structural tailwinds that are not dependent on economic cycles. Third, the full realization of Powering Care savings. The company has guided to $3 billion or more through 2030. As those savings flow through, margins expand, and EPS can grow even in a low revenue growth environment. Execution on cost is the near-term catalyst to watch.
Wall Street's view on KMB is a consensus hold, which is the polite way of saying analysts like the business but are not sure the stock will outperform from here in the near term. Price targets cluster around $145, implying about 7% upside from current levels, not including the dividend. The debate centers on whether Powering Care savings can offset volume headwinds and whether the emerging market recovery is credible and durable. Some analysts have raised estimates modestly after the Q1 beat. The ones who remain cautious point to the organic revenue decline as evidence that pricing normalization is a prolonged headwind. No significant upgrades or downgrades followed Q1, which tells you the result was largely in line with what the street expected, even if the EPS number was slightly above consensus.
On valuation, Kimberly-Clark trades at approximately 22 to 23 times forward earnings, which is roughly in line with its consumer staples peer group. The argument for owning it at this multiple is the combination of a 3.6% dividend yield, 51 years of consecutive dividend growth, and a management team actively restructuring the cost base to drive margin expansion. For income-oriented investors, or those rotating into defensive sectors, KMB screens well. The argument against is that 22 to 23 times is not cheap for a company with flat to negative organic revenue growth. You are paying a premium for stability and the dividend, not for growth. Relative to higher growth consumer names, the valuation requires patience and a long time horizon to deliver meaningful total returns.
Bull case number 1. Powering Care delivers on its cost savings promise ahead of schedule. Kimberly-Clark has guided to $3 billion or more in savings through 2030. If restructuring execution accelerates, margins expand faster than the market currently models, EPS surprises to the upside, and the stock re-rates higher on improved earnings quality. The Halex separation has already streamlined the portfolio, and each subsequent savings milestone removes another layer of uncertainty. Bull case 1 is fundamentally a bet on management execution, and the Q1 EPS beat provides early evidence they are on track.
Bull case number 2. Emerging market diaper volume recovers. Kimberly-Clark's share in Brazil and China was pressured during the pricing cycle, but the underlying consumer demand in those markets is secular and durable. As pricing normalizes and Kimberly-Clark re-engages with promotional and distribution investment in emerging markets, volume recovers. This drives organic revenue back into positive territory, which is a meaningful sentiment shift for a market that has been discounting the stock based on the organic decline narrative. A return to positive volume growth in just one or two major emerging markets would be enough to change the tone of analyst commentary significantly.
Bull case number 3. Adult incontinence becomes a recognized growth segment. The Depend and Poise franchise is undersized relative to its demographic opportunity. As the global population ages and awareness of adult incontinence products increases, this segment can deliver consistent mid-single-digit or better growth for years. If Kimberly-Clark invests behind the category with targeted marketing and product innovation, and if that spending drives share gains, the market will begin to assign a higher multiple to this portion of the business. Consumer staples companies with demonstrable growth segments trade at premiums, and adult incontinence could be that vector for KMB.
Bear case number 1. Private label competition erodes tissue and paper margins permanently. Costco Kirkland, Amazon Basics, and retailer store brands have become credible alternatives to Kleenex and Scott in ways that were not true 5 years ago. If consumers who traded down during the inflation cycle do not trade back up to branded products, Kimberly-Clark's tissue segment faces structural margin pressure. Private label penetration in tissue has been rising across developed markets, and there is no obvious catalyst to reverse that trend. If branded tissue pricing power is structurally impaired, a key pillar of the investment thesis is weaker than management acknowledges.
Bear case number 2. Emerging market FX and slower than expected recovery compound the organic revenue weakness. The organic revenue decline of roughly 3% in Q1 is manageable if it is transitional. But if volume recovery in Brazil and China stalls, and if currency headwinds from those markets persist, organic growth could remain negative or flat for multiple quarters. That scenario undermines the earnings growth story because cost savings alone cannot fully replace revenue momentum. Add ongoing restructuring charges hitting reported earnings, and the stock may remain range-bound well into 2027. Investors willing to hold for the income may be fine, but total return expectations need to be calibrated for an extended period of patience.
The bottom line on Kimberly-Clark: this is a dividend king executing a credible restructuring while navigating a difficult organic revenue environment. The Q1 EPS beat of $1.97 against a $1.93 estimate shows management can protect the bottom line even when top-line growth is absent. The 3.6% dividend yield, 51-year growth streak, and powering care savings trajectory give income-focused investors a defensible reason to hold. Growth investors will need to see volume recovery in emerging markets and a recognized adult incontinence tailwind before the multiple expands. The consensus hold reflects a fair price at current levels. Upside to 145 is achievable if restructuring execution stays on pace and organic revenue stabilizes. Financial data sourced from Financial Modeling Prep. Charged alpha is for educational purposes only and does not constitute investment advice. Always consult a qualified financial advisor before making investment decisions.
Ooh-wee-doo! That ticker tape starts dancing fast. A bull market thrill that's built to last. Dividends are ringing up the swing. Listen to that sweet ka-ching. It's a Wall Street swing. That fast-paced rhythm makes you sing. Yeah, the Wall